Hello and welcome back to the Note. Well, perhaps the only positive thing I can find to tell you about today's trading on Wall Street was that it at least gives me an excuse to quote from the Monty Python Dead Parrot sketch. It looked as though we had a dead cat bounce for equities today. By the end of the day, it was clear that that dead cat was indeed truly bereft of life. It had ceased to be. It was an ex-cat. Now, overnight here in the States, we had the news that there'd been another sell-off in China, that there had been a response from the People's Bank of China in terms of cutting rates and of reducing reserve requirement ratios. That had led to a very big rebound in European equities. It led, as you can see, to that bounce at the open. By the end, though, confidence appeared to have evaporated. We're down more than 1% for the day. We're nearly back to the lows of the bond flash crash of October of last year. A fall intraday of some 4%. Really very hard to spin in any positive way at all. Every one of the main industrial sectors covered in the S&P, including now even healthcare, is now down for the year. Now, if we take a look at the volatility index, measuring the implied volatility of the S&P, similarly, this is the whole post-crisis period. Those two spikes you see earlier are the first wave of the Eurozone crisis in 2010 and the crisis over the debt ceiling here in the States in 2011. This is now very clearly, as far as the market is concerned, the scariest incident since then. Now, you could argue that basically what the PBOC did simply wasn't enough to restore sentiment. They've had interest rate cuts and changes to the reserve requirement ratio several times already, and it hasn't helped. But it could also be that actually it's not just China. If we take a look at this next chart, which is produced for us by Absolute Strategy Research of London, yellow and green lines there show you changes in durable goods orders for the G3, the main three industrialized economies. And you can see very clearly that when they dip negative, as they have clearly done recently, you tend to see a fall in interest rates. That suggests there really is concern out there about the global economy, and that translates into speculation about the Fed. Now, very intriguingly, we're no longer just talking about delaying the hike that the Fed would like to make in interest rates next month. There is a lot of chatter today about QE4, about yet another dose of bond purchases to stimulate the market. I have to say that sounds very alarming to me, the mere idea that that might be necessary. Presumably, it would help the market in the short term, but it tells you something about the way sentiment has been damaged in the last week that people are even talking about it. For the time being, I'm afraid to say confidence in the US is a dead cat. It really has ceased to be.